How internal valuation reports help companies make better decisions. When people hear the term business valuation, they often think about fundraising or selling a company. But valuations are not only used when raising capital or preparing for an acquisition. Many companies produce internal valuation reports to help management and the board understand how the business is performing and where it is heading. An internal valuation report is essentially a strategic business intelligence document. It combines financial performance, operational metrics, market analysis, and valuation models to help leadership teams make informed decisions. In this video, we will walk through the key sections of a typical internal valuation report and explain why each section matters. First, the report begins with a company overview and financial foundation. This section provides the basic context for the business. It includes information such as the company's industry, stage, location, and team size. For example, a SaaS company might be described as operating in the cloud software industry, founded in 2021, with 35 employees and headquartered in Dublin. This section also includes key financial indicators such as revenue, growth rate, customer numbers, and profit margins. These numbers help establish the financial foundation of the company before deeper analysis begins. In many SaaS businesses, metrics like sum annual recurring revenue, often called ARR, and HA monthly recurring revenue, known as MRR, are particularly important. Recurring revenue models are attractive because they create predictable income streams and long-term customer relationships. Management teams use this section to understand how the company is performing at a high level. Next, the report examines the PROW, business model, and strategic positioning. This explains how the company generates revenue and what makes its product or service valuable. For example, a software company may provide analytics tools that automate complex processes, helping customers reduce manual work and improve efficiency. This section also evaluates scalability. Scalability refers to how easily a business can grow without costs increasing at the same pace as revenue. Technology businesses often scale well because once the product is built, it can be sold to many customers with relatively low additional costs. Understanding scalability is important because highly scalable companies often command higher valuations. After the business model, the report analyzes financial health indicators. These metrics measure whether the company's growth is sustainable. Key indicators include revenue growth, profit margins, customer acquisition cost, and customer lifetime value. Customer acquisition cost represents how much it costs to acquire a new customer. Customer lifetime value estimates how much revenue that customer will generate over time. When lifetime value is significantly higher than acquisition cost, the business model is usually considered healthy. Management teams monitor these metrics closely because they directly influence long-term company value. Internal reports often include a live performance dashboard. This dashboard tracks operational metrics such as monthly revenue, retention rates, hiring progress, and budget performance. These dashboards help leadership quickly identify where the company is meeting targets and where it may be falling behind. For example, if revenue growth is strong but customer retention is declining, management may need to focus on improving product quality or customer support. The dashboard allows executives and board members to track performance in real time. Another important section focuses on strategic objectives and company milestones. These are the goals that leadership is working toward. Examples might include reaching $10 million in annual recurring revenue, launching a new product tier, expanding into new geographic markets, or preparing for a future funding round. Tracking progress toward these milestones helps management ensure that the company remains aligned with its long-term strategy. The report also examines the company's team structure and workforce analytics. Human capital is one of the most important drivers of value in modern businesses. This section analyzes employee retention, productivity, team satisfaction, and hiring plans. High-performing teams with strong retention rates are generally associated with more stable and scalable businesses. Companies also track hiring roadmaps to ensure they have the talent needed to support future growth. Another key component is market analysis and competitive positioning. This section evaluates the size of the market opportunity. 3 common metrics are used. Total addressable market represents the maximum possible market size. Serviceable addressable market represents the portion of the market that the company can realistically serve. Serviceable obtainable market represents the share the company believes it can capture in the near term. Understanding market size helps management determine whether the business has the potential to grow significantly. The report may also analyze competitors and identify competitive advantages such as proprietary technology, intellectual property, or strategic partnerships. A critical part of any internal valuation report is the risk assessment. Every business faces risks. These may include market competition, regulatory changes, financial pressures, or operational challenges. The report evaluates these risks and models how they might affect revenue and valuation. For example, economic downturns could reduce customer spending, while technological breakthroughs could increase market demand. Scenario analysis helps management prepare for different outcomes and develop contingency plans. Next, the report applies multiple valuation methodologies. Professional valuations rarely rely on a single method. Instead, several approaches are used to estimate value from different perspectives. One commonly used method is discounted cash flow, which estimates the present value of future cash flows. Another is market multiples, which compares the company to similar businesses that have been sold or publicly traded. Early-stage companies may also use methods such as the venture capital method, the scorecard method, or the Berkus method. By applying several methodologies, the report produces a valuation range rather than a single number. This approach provides a more balanced and defensible estimate of company value. Internal valuation reports also include scenario modeling and sensitivity analysis. This analysis explores how changes in key variables could affect company value. For example, what happens if growth slows by 20%? What happens if customer acquisition costs increase? Or what happens if a major competitor enters the market? Scenario analysis helps leadership understand which factors have the greatest influence on valuation. Finally, the report includes recommended actions and strategic insights. This section summarizes the key findings and highlights areas that require attention. It may recommend improving operational efficiency, reducing customer concentration risk, expanding into new markets, or strengthening financial reporting. The goal of the internal report is not simply to estimate a valuation, it is to provide a strategic roadmap for management and the board. Internal valuation reports are typically updated regularly. Early-stage companies may update them quarterly, while more mature companies often update them annually. Regular valuation updates allow companies to track how their strategic decisions influence long-term value. In summary, internal valuation reports provide a comprehensive view of a company's financial performance, operational efficiency, market position, and future potential. They help leadership teams make better decisions, monitor progress, and prepare for future fundraising or strategic transactions. If you want to understand how these reports are structured or generate your own valuation analysis, you can explore professional valuation tools and resources available online at www.valuationforyou.com. And if you found this video helpful, like the video and subscribe for more clear guides on business valuation.